Welcome to It's the Economy. One of the sharpest cuts to the GDP of Asian countries post the April 2nd reciprocal tariff announcement came from Goldman Sachs. They had brought down Vietnam's GDP by 1.2 percentage points from 6.8 to 5.6. Taiwan's was cut by 1 percentage point. India's GDP was cut by 30 basis points to 6.1%. But now that the tariffs have been paused for 90 days, does Goldman Sachs have a slightly less worrying view of Asian and Indian growth? What are the specific positives, if any, for India from the domestic policy changes like, lower interest rates and easier liquidity? For all questions, India and maybe a bit global, I'm joined by Santanu Sengupta, Chief Economist of Goldman Sachs in India. Shantanu, good morning. Thank you very much indeed for joining us. Well, any second thoughts on India's GDP forecast? Any upside risk to your number?
Well, we are sticking to 6.1% year over year for both calendar 25 as well as fiscal 26. Look, I mean, the issue is with the uncertainty. It's not just the direct impact of the tariffs, but this flip-flop that you're having multiple times now, not just at a country level, but also at a sector level, makes it fairly uncertain for especially GFCF or investment growth, which is why we are sticking to the number of 6.1% year over year for growth. In terms of upside versus downside, clearly there'll be two other downsides. One from services exports, and we have been very bullish about services exports in India throughout this period, last two or 3 years. But this time round, we think that if US growth is slowing down, and our US economists think that we are getting towards 0.5% year over year, Q4, that is by the Q4 of the calendar year. If you're slowing down that much, then undoubtedly in our mind, services exports is going to be hit. You're going to see IT earnings also coming through and get some guidance on that. Secondly, if oil prices are here, there is good oil price decline and there is not so good oil price decline. If oil prices are declining so much, we also think that remittances will be hit a little bit. But on the offset side, you'll have lower oil price feed through into our oil imports and give us an oil boost through the current account. And secondly, we think that monetary policy now is in an easy path, right? I mean, the governor was very clear also. You've seen the change in stance to accommodate, and therefore we think that 50 basis points of more rate cuts and therefore further upside from monetary policy.
Okay. Yes, sir. I wanted to refer to your, current account deficit paper as well, which you wrote in March. I think you had a full year current account deficit of 1% of GDP for last year. What are you expecting for this year? Do you expect the current account? I think you went with 1% for this year as well.
Yeah, so the current account deficit overall can be 1% of GDP because of offsets that you're seeing a little bit from remittances, as I said, and the services export drag. But the oil price boost that you're seeing will feed through into the domestic economy. We are unsure about what that channel will be ultimately. So there could be two options, right? One, you hike excise duties and you feed this through the fiscal, and the government figures out what to spend this on. Or eventually you could have a direct cut at the pump price level for petrol and diesel, which is a direct boost for the consumer and the overall aggregate economy. Because remember, this kind of a price cut is difficult to save. An income tax cut, you can have some savings going on. But in this one, we think that it'll transmit through the economy faster. So we are unsure about what that path will be, but we are pretty sure that that will act as a boost for growth.
For growth. Okay, so are you expecting a downside risk to your inflation forecast? Your inflation forecast is among the lowest, 4%, like the Reserve Bank. Do you think it can be even lower than that if oil price cuts are passed on? And a related question, therefore, almost all of you on the street are expecting that 5.5 will be the end repo rate at the end of probably by August. Do you expect it can go even lower?
So firstly, on inflation, yes, clearly. I mean, the 4% inflation forecast that we have is with the with pump prices not changing. But if indeed oil price declines are passed through to the consumer, then we would have downside risk to the 4% inflation forecast that we have. Right now, what we have built in is only the second round effect that feeds through from WPI inflation into core goods and so on. But if you have a direct pass through, we think there's further downside risk to inflation. Now, to your second question, our sense of what the governor said about, he clarified on the accommodative stance, is that the real neutral rate for the RBI is between 1.4 to 1.9. So let's call it like 1.5 to 2%. If inflation is at 4%, then you should be able to get to at least 550.
Okay.
But if you think that your output gaps are widening, which is that you're growing below potential, call it like the middle of the year, then there's a possibility that the RBI goes in for a deeper rate cutting cycle where the neutral, where they go below the real neutral and have real neutral, let's say at 1% or 1.25%. That will give you a deeper rate cut. Our sense is, with so much uncertainty, I mean, for the central bank also, it's difficult to call it out 6 months down. And therefore, they'll probably go towards 550, keep liquidity easy, which we think is the most important thing. I mean, you've seen this market for long enough also, Latha. Ultimately for transmission, what matters is liquidity. So if the liquidity is benign, then that will feed through into the domestic economy and provide a boost to growth. We are factoring in about 10 to 20 basis points of growth offset coming in from monetary policy.
No, actually, I pointedly asked the governor this question on whether he would go for a lower real rate and therefore the end repo rate would be a 5/4. Well, he obviously didn't commit himself, but it did look like he was more dovish than the 5.5 would warrant. Santanu, you began by this entire conversation by saying that your US economists are marking down the growth in that country, and that's why you are expecting perhaps lower services export flows. What exactly is your team speaking about the US economy? Are they expecting a recession? A lot will follow through from that.
No, we are not in the recession camp, particularly because the Trump administration reversed the tariffs. We still think it is very elevated, though, the recession risks. We are at 45% recession risk for the year, which is pretty meaningful. I think there are a few questions that remain. One is, whether the exemptions or the rate reductions that you've had for telecom, semiconductor equipments, will that remain in place? Will Chinese firms be able to reroute exports to the US via other Asian economies? Or is there any hope of an agreement that brings the broad tariff rate back towards more reasonable levels? So right now, even the 10% tariff rate remains. So if you have a little more beneficial or mutually beneficial trade going on, that is when you can pass without slipping directly into a recession. Overall, the economy was pretty healthy on the US side as you entered into the trade war. And therefore, we don't have the recession call yet. We still think that the Fed goes ahead and cuts thrice in the second half of the year. But again, the uncertainty is what is keeping US growth muted and the recession odds fairly high at 45%.
Okay. What's the Goldman Sachs view on the dollar and the rupee? It's very confusing. The dollar's index has now gone below 100. If one looks at it, the whole effort of the Trump administration is to lower the deficits they have with each country. What does all this mean? I mean, has the rupee seen its worst in terms of 87, 95? Both a dollar and a rupee view.
So the dollar view is slightly different from what you're going to see on the dollar rupee in our opinion. Okay. One, on the dollar view, the broad dollar view, we think the weaker trend in the dollar continues. Firstly, there's this combination of unnecessary trade war and the uncertainty, which will be impeding business confidence. Yeah. Secondly, you're seeing the trends in the flip-flop from the governance side from the US, right? And that sort of eats into the appeal for the safe haven status of the dollar. And therefore, we think that the weak trend in the dollar continues. So for euro dollar, for example, we are looking at anywhere between 115 to 120 by the end of the year. Whereas for the dollar CNY, which is more specifically Asia, if you're really imposing that kind of tariffs, we don't think Asian central banks, particularly China, will have the incentive to let their currencies appreciate meaningfully. You've seen it in the CNY move also in the previous week a little bit.
Yes.
Therefore, we think that the CNY stays in the 735 kind of zone. Our call is for the dollar rupee to therefore be around 87.5, 88. Look, if you're having an overall, even 10% tariffs and a growth slowdown on account of that, it does not make a lot of sense for your currency to appreciate in that situation. So we think that if flows are to come back in the future, central banks, particularly the RBI, will stand in the way, will try to mop up and rebuild reserves is what our thought process is. So we are looking at 87.5, 88 on the dollar rupee.
Okay. No, I agree. Actually, even today, I'm surprised that the RBI has allowed the rupee to appreciate to about 11.6 versus the CNY. For the longest time, we were closer to 12. So maybe this is a passing phase, and we are going to see the rupee also depreciate, as you say, towards 87.50. The final question, and I'm trying to squeeze in, do you think India has any advantages? I mean, we hear a lot of positive noise that we will replace Chinese exports, especially in iPhones. Do you see India gaining because of the new trade order?
So, firstly, in the short term, we think it's good that there is no retaliation from India. And our understanding is that the US and India are working on a trade deal with the aim of increasing bilateral trade. In fact, the Ministry of Commerce clarified right on the day when the announcements were made that discussions were ongoing between the US and Indian trade teams for a mutually beneficial multi-sectoral bilateral trade. You've already seen oil imports slightly increase. We think that there can be further deals on defense. And once the dust settles, you can have a relook at the new world order, and India can make its place known there. For the interim period, though, we think that uncertainty is what will dominate. That's the point that we are trying to say, that whether the tariff rates are high or low, the fact that it is changing so many times will just lend uncertainty in the minds of anybody who's trying to put up capacity. So even if you want to realign your trade and move into India, you will want the dust or the uncertainty to settle down before you do that. So not in the interim, maybe in the longer term.
Oh yes, sir. There's no doubt that global investment is going to suffer because of the uncertainty. Why would you want to invest anything? But you keep saying when the dust settles. I hope the dust settles. At the moment, there's no such sign. Thank you very much, Santanu Sengupta, for giving us some understanding of what is several moving pieces. But we are a little wiser after this chat. Thank you very much for joining us. We have to wrap up on Bazaar on that note. It's a good day for the rupee and for equity markets. The action will be taken forward by Chartbusters after the break.